In this segment, we will discuss Chapter 5, which deals with statements of net income and comprehensive income. Now, Chapter 5 highlights the importance of income statement items and indicate that income, revenues, and gains, less expenses and losses, is one of the most important numbers companies report. So, to obtain a complete picture of financial performance, however, as it relates to net income, companies may present steps and subtotals in arriving at net income. Chapter 5 delves into the reporting of net income on the income statement and the statement of comprehensive income. Single step and multiple step statements are discussed as part of the conversation of reporting requirements. In addition, Chapter 5 addresses the differences in reporting of net income between GAAP and IFRS. So we're going to look into the objectives of Chapter 5. 1, explain the difference between net income and comprehensive income. Assess the usefulness and limitations of the income statements. 2, define earnings quality, including permanent and transitory earnings and earnings management. 3, identify the 4 primary elements on the statement of net income and explain the nature and functional approaches to classifying items. 4, explain the presentation of the statement of net income, including the multiple step and single step income statement formats. 5, define income from continuing operations, including the components of operating income, non-operating income, and income tax provision. 6, demonstrate the accounting for a discontinued operation, including the criteria used to determine a discontinued operation and presentation on the statement of net income. 7, describe the presentation of net income, non-controlling interest, and earnings per share on the statement of net income. 8, discuss the statement of comprehensive income. And 9, describe the components of and the reporting requirements for the statement of stockholders' equity. So our first objective is explain the difference between net income and comprehensive income. Assess the usefulness and limitations of the income statement. The first step in our discussion of the income statements is outlining important terminology, the requirements for reporting the 2 components of comprehensive income, and the key advantages and limitations of the income statements. Now, comprehensive income is the change in a company's equity during a period of time resulting from transactions, events, and circumstances other than transactions with owners. For example, comprehensive income does not include new issues of shares or dividends distributions. Comprehensive income is composed of 2 parts. You have your net income and other comprehensive income. So comprehensive income is equal to net income plus other comprehensive income. So what is net income? Net income is a measure of financial performance resulting from the aggregation of revenues, expenses, gains, and losses that are not items of other comprehensive income. Net income is also referred to as net earnings. Other comprehensive income is composed of revenues, expenses, gains, and losses that are explicitly excluded from net income in Pacific accounting standards. Standard setters specify that other comprehensive income includes unrealized gains and losses on an available for sale investment portfolio, unrealized gains and losses on cash flow hedges, foreign currency translation adjustments, and certain pension adjustments. Transactions that are not captured in the income statement are accounted for in other comprehensive income report. It entails items such as gains or losses from pension and other retirement programs, or adjustments made to foreign currency transactions. As you can see from this statement of comprehensive income, you have your net income or earnings, and then you also have the other comprehensive income adjustment for certain investments, which is $100,000. So your total comprehensive income is $2,050,000. Income statements are designed to reflect all components of comprehensive income, representing an entity's financial performance and results of operations over a period of time. Entities may report comprehensive income in two ways. One, in one statement, usually called the Statement of Comprehensive Income, or in two consecutive statements, which are the Statement of Net Income and the Statement of Comprehensive Income. Now, the computation of net income and comprehensive income are the same under either alternative. Only the format of the presentation differs. Here is an example of net income and comprehensive income statement. The income statements provide useful information to financial statement users in three ways. One is to evaluate past performance. Now, income statements enable financial statement users to evaluate the entity's past performance. By disclosing separate components of revenues and expenses, income statements provide useful information about the entity's overall past performance, and it also identifies the main factors that influence performance. Now, income statements provide confirmatory value, which is an aspect of relevant information. For example, investors are interested in whether companies meet or beat analysts' forecasts of net income, as indicated by the Statement of Net Income. Two, predict future performance. Income statements have predictive value because they provide a basis for estimating future performance. Predictive value is an aspect of relevance. For example, a firm with a trend of earnings growth over the past 10 years may continue that growth in the future. 3, assess risk or uncertainties of achieving future cash flows. Income statements provide information that is useful in assessing the risk or uncertainties of achieving future cash flows. Some items of income are more persistent of future cash flows. For example, revenue from normal sales trends. Revenues from normal sales tends to persist from year to year. However, a gain from the sale of a specialized piece of equipment is unlikely. It is unlikely to reoccur in the following year. While income statements are quite important to financial statement users, there are three main limitations. There are three main limitations of income statements. One, income statements may exclude certain items. Now, companies cannot measure certain revenues. They can't measure certain expenses, gains, and losses. So they do not report them on the income statement. Unreliable information would result in financial statements that lack faithful representation, which is one of the fundamental qualitative characteristics identified in the conceptual framework. For example, assume that an entity has been sued and a loss is likely. If the firm cannot reasonably estimate the loss, it would not report it on the income statement. The second limitation of an income statement is depend on accounting method selected. The measurement of income is dependent upon the accounting methods selected. For example, identical companies that purchase the same asset but depreciate that asset using different depreciation methods will report a different net income, resulting in a reduced comparability. The third limitation of income statement is it requires extensive judgment and estimation. In general, allowing managers to use judgment when making accounting policy choices that best reflect the economic reality of a transaction will enhance the usefulness of the financial statements. However, due to significant subjectivity and estimation uncertainties involved in financial reporting, management can bias their judgments to enhance the entity's financial performance by manipulating revenues, by manipulating gains, expenses, and losses. Even if management is not intentionally biasing reported earnings, different judgments will lead to different income numbers, resulting in reduced comparability. We are at the end of objective 1, where we explain the difference between net income and comprehensive income. So what is the formula for comprehensive income? The formula for comprehensive income is comprehensive income equal net income plus other comprehensive income. Our second objective is define earnings quality, including permanent and transitory earnings and earnings management. All the information included in the financial statements is important, and they're useful for assessing a firm's financial position and performance. Yet, earnings is the single most important measure for financial statement users. Preparers, auditors, regulators, and academics, they devote a considerable amount of time to focusing on earnings quality. Earnings quality captures the degree to which reported income provides financial statement users with useful information for predicting future firm performance. Here, we're going to focus our discussion on two factors that impact earnings quality. And one is earnings quality is dependent upon whether the components of earnings presented are permanent or transitory in nature. 2, Management will sometimes engage in earnings management by using the discretion afforded under the accounting standards to manipulate earnings to meet desired goals. In assessing earnings quality, financial statement users gauge the portion of reported earnings that are permanent versus those that are transitory. Permanent components of earnings are likely to continue into the future. For example, earnings from sales revenue from regular customers are likely to continue into the future. Transitory components of earnings are unlikely to continue in the future. For example, gains or losses from the sale of equipment are usually transitory. Permanent earnings result in higher earnings quality, while transitory earnings result in lower earnings quality. The order of the income elements on the statement of income guides financial statement users in distinguishing the permanent and transitory elements. Elements presented earlier in the statement of comprehensive income are typically more permanent than those included later in the statement. Here you see in Exhibit 5.1, it lists income statement line items commonly viewed as permanent and transitory. Now, elements in the other comprehensive income statement are often transitory in nature, such as unrealized gains and losses on investments that are held by the entities, Also, income that is included in special sections of the statement of net income, such as income from discontinued items, is typically transitory. Generally, these elements occur in 1 year and then do not reoccur in the foreseeable future. Most elements presented in operating income are permanent in nature. For example, salary expense. Salary expense related to an entity's sales force is likely to occur every period for the foreseeable future, right? However, not all elements included in operating income are considered permanent. An example is discretionary expenses such as R&D, research and development expenses, and training expenses are generally more transitory. Now, given the issues and concerns with the usefulness of the income statements and earning quality, Appendix A introduces financial statements analysis as a technique for understanding and interpreting a company's performance. So again, in Exhibit 5.1, you see examples of permanent and transitory items. Permanent, consider your sales, your cost of goods sold, selling expenses, interest expense. They're permanent. Transitory, they change. Gains and losses on disposal of long-lived assets, impairment losses, discontinued operations. Those are considered transitory. So a company's management understands the company's financial position and performance best. Now, managers who are honest and have a desire to communicate accurate information to their stakeholders can do so. However, We do have managers that may use the areas of judgment inherent in financial reporting to manage earnings in an optimistic and sometimes fraudulent manner. An example, managers must determine which expenditures for equipment are material enough to record as an asset as opposed to an expense. They will likely expense a stapler but not record a tractor as an asset. There is a gray area. There's a gray area in this type of decision that provides an opportunity for earnings management. For example, should we expense a chair or record it as an asset? Of course, recording an asset for material expenditure that the authoritative literature clearly designate as an expense constitutes fraud. Extreme forms of earnings management are fraudulent, and of course, they are illegal. The flexibility in accounting standards gives management the ability to manipulate its reported earnings to meet companies' objectives. One of the manager's overriding goals for the earnings presentation is to meet or exceed analysts' earnings forecasts. Financial analysts are trained to analyze a company, summarize relevant financial information for investors, and provide an opinion about whether investors should buy or sell stock in a company. In addition, financial analysts publish forecasts of a company's sales and earnings. Now, if the company's actual earnings fall below this forecast, the market will most often react negatively, causing a drop in stock price. So managers are also motivated to manage earnings to, one, beat benchmarks such as prior quarter earnings or earnings from the same quarter of a prior year. Two, avoid reporting a loss. Three, present a firm's earnings as a smooth upward trend. And four, increase their own compensation when bonus plans are based on the net income or stock price of the firm. Managers employ earnings management techniques when actual earnings are either lower or higher than expected earnings. When low earnings are expected, the big bath earnings management technique involves increasing a net loss to allow the firm to show increased net income in the future. Managers can intentionally report very low or negative earnings in a period by accelerating the recognition of expenses into current period earnings or deferring revenue recognition to the future reporting periods. Now, this then allows them to report higher earnings in future periods than they would otherwise have reported because they have shifted expenses back to the prior period or shifted revenues to the future period. When earnings are higher than expected in the current period, managers may elect to reduce earnings to create a cookie jar reserves. Now, cookie jar reserves are used in future periods to increase earnings as needed, possibly to exceed analysts' forecasts. For instance, managers could recognize an overstated warranty expense when earnings are high, thus increasing warranty expense and warranty liability and reducing reported earnings. In later years, the manager have a sufficient warranty liability and may not need to increase the accrual. Therefore, management can report lower warranty expense and increase reported earnings in that period. Here you see Exhibit 5.2, Earnings Management Approaches Used in Practice. A survey of auditors provides a summary of the approaches management uses to manipulate earnings. The most common approach is through the manipulation of expenses and losses. (52% of the occurrences of an earning management attempt), followed by the manipulation of revenues, which is 22%, and opportunities around business combinations. Okay, we are at the end of Objective 2. Describe the Big Bath Earnings Management Technique. When low earnings are expected, the Big Bath Earnings Management Technique involves increasing a net loss to allow the firm to show increased net income in the future. Now, we know that managers can intentionally report very low or negative earnings in a period by accelerating the recognition of expenses into current period earnings or deferring revenue recognition to the future reporting periods. Now, this then allows them to report higher earnings in the future period than they would otherwise have reported because they have shifted expenses back to the prior period, or they shifted revenues to the future period. And that's the end of Objective number 2. Thank you for watching. And please, if you haven't already, please click the subscribe button below. And also look out for our next video. Thank you for watching.